In this video, I want to talk about 3 undervalued stocks to buy in 2026. I will talk about 3 specific companies that I believe have a lot of potential to outperform the market in 2026 and later. So these are companies that are good, that are efficient, but the stock price is not that great, not good looking right now. So maybe the stock is cheap. And maybe I'm buying more of these companies because, full disclosure, out of the 3 companies, I own 2. And I am doing some research on the third one. So I believe if you buy these 3 companies right now, you have a good chance of outperforming the market. So the 3 companies we are going to talk about today are 1. Adobe, 2. MercadoLibre, 3. Meta platforms. If that's interesting to you, you can stay. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I recently opened a position into Adobe, and I want to increase the allocation. I want to buy more. If you look at Adobe, you all know Adobe. You all know it's a Photoshop, the PDF company. You all know they have an ecosystem for designers, for all the artistic people of this world. You all know this license, this ecosystem that is 30 years old, even more than this. They have a long history of being aggressive with competitors. They have a long history of embracing the new technologies. They have shifted into a subscription-based business model 10 years ago. They were doubted and they won. And now there is this big risk with AI. They will be disrupted by the AI. And it seems like Adobe is just starting right now to fight back. Will they win? Will they lose? Nobody knows. My opinion is they will win. This is why I'm buying. If I had thought that they would lose, I would not invest, right? So I think Adobe is embracing AI, this disruption risk, and I think they will benefit out of these new investments because the ecosystem for Adobe is strong. And it seems like we are the minority here that are being bullish. Full disclosure, I was being bearish on Adobe a few quarters ago. I didn't have the conviction to buy Adobe a few quarters ago because I did not see them fighting back against AI. And for the past quarter, it seems like they are starting to fight back, which is extremely bullish. And this is something I was monitoring a lot with Google a few months ago. And Google started to fight back and Google started to win. And now Google is at an all-time high. So maybe Adobe can do the same. The sentiment can shift. Right now, the sentiment is pretty bad. If you look at the past 5 years for Adobe, the stock has done nothing. And after COVID, the stock went up a lot. And then the stock went down a lot. The sentiment was horrible back then. And in 1 year, the sentiment turned. In 1 year, the stock doubled, and now the sentiment is bad again, which means it's all about conviction, it's all about sentiment, it's all about the mood, it's all about the future growth rate, etc. The stock can double in 1 year. It's possible. They just did it in 2023. So there is a scenario that is possible where Adobe doubles in 1 year. This is possible. They just did it 2 years ago. Maybe it will not take 1 year, maybe 2 years, but I think the odds of Adobe surviving and succeeding are increasing right now because they are delivering more and more AI products, AI services, AI implementation, AI monetization, which we didn't have a few months ago. This was the reason why I was not buying a few months ago and quite negative about the company. And now I changed my mind because they changed. The thesis just changed. They are reaccelerating. So they are agile. They can pivot very fast because they have a stellar business model. The gross margins are at 90%. The net margins are at 30%. They are growing revenue minimum 10% per year. The revenue is up and to the right. The net income is up and to the right. The free cash flow is up and to the right. And now they are accelerating their buyback program. The stock is down, the stock is cheap, so they are doing more buybacks. They don't have a debt problem. They can tap into more debt if they want to. They have a ROIC, return on invested capital, of 15, 20, 25%. So they are efficient, asset light, a lot of buybacks, a lot of cash, a lot of growth. And you can have this business at a price to free cash flow of 15. That's it. This is definitely my sweet spot of a quality compounder, quality company, buyback cannibal that is trading at a reasonable valuation. So definitely my sweet spot of investment, guys. I just told you at the beginning of the video, I have generated 25% per year by investing in these situations. Quality companies trading at a reasonable price. I believe Adobe is a quality company trading at a cheap price right now. So maybe it's even better. As always, I can be wrong, I can be right. Anything is possible. But I'm buying right now. So you have my opinion on Adobe. Full disclosure, right now as I'm speaking, it's 6.5% of my portfolio. Okay, so it's an okay position and I want to increase the exposure. I don't know how many percentages, I will let you know. But I'm a shareholder, so I'm biased, obviously. Be careful with what I say. But in case you did not start the research on Adobe, maybe now is a good time because now the stock is hated. They reported earnings a few weeks ago, pretty good earnings, hated. Nobody cares about Adobe. People just look at the stock price that goes down and people cry. This is the kind of due diligence people do. People compare Adobe to Canvas and they cry again and they panic. People don't go really deep in the analysis of Adobe. And I'm glad to take the other side of this bet. We will see if this video will age well or not. We will see. Anything is possible, but for the moment, I'm buying. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second stock for you guys is MercadoLibre. MercadoLibre, you probably know this company as the Amazon of Latin America. They have two big segments, the e-commerce part and the fintech part, the fintech segments. So it's slightly different from Amazon. Amazon is into logistics, e-commerce, but also video streaming, but also many things at the same time, advertising, etc., AWS, etc. MercadoLibre is just e-commerce and fintech. You have a continent that is underbanked. You have a continent that is still in development, developing countries over there. So you have an untapped potential of reaching millions and millions of people over there. It's a market that is unpenetrated for the moment, and it is growing massively. MercadoLibre is succeeding in doing this. They are growing revenue 30% per year. They have been growing revenue 30% per year for so many years now. I think they reached the record of a quarterly growth rate of 30% ever. I think this is the most amount of consecutive quarters when a public company can grow 30% per year. So seems like they're doing something right. You have some geographical risks because of political pressures there, governments that are not perfect over there. Whose government is perfect? So you have risks when it comes to their geographies and their countries. But despite all the risks, despite all the uncertainties, MercadoLibre is growing. And they are growing with all the force they can. When Amazon wanted to tap into their market, MercadoLibre fought back. When other competitors, local competition, wanted to enter this market, MercadoLibre fought back. MercadoLibre is doing the Amazon flywheel effect, Costco effect, which means they are purposely reducing their own margins to invest in their own logistics to improve the quality of the delivery, to have faster deliveries, more efficient deliveries, so customers are happy. And they've been doing this for, I think, 2 or 3 times for the past decade of willingly reducing your own profitability in the short term so that you can grow your revenue in the long term. And this has worked out okay because the revenue has grown 30% per year. So when it comes to resilience and growth and TAM, total addressable market, it's very hard to beat MercadoLibre. You have a lot of potential for MercadoLibre. The revenue is skyrocketing, spectacular growth rate in revenue. The net income is a little bit of a mess. You have years with negative net income, losses, because what I just said, implementation of new rules to lower your margins and improve your growth. And a few years ago, they went into diversification and they went into the fintech market, fintech segment with Mercado Pago, etc., etc. This is working out okay, and this is also the reason why the free cash flow is different from the net income. If you look at the net income for this company and the cash from operating activities, or even the free cash flow would be the same. You have different lines. In blue, you have the net income of the company that just turned profitable positive in 2021. And in orange, you have the free cash flow. What is happening with your free cash flow? Why is your free cash flow 4 times higher than the net income? The difference is fintech. Okay? The fintech segment. This is just how accounting works. You have some deposits, you have some capital from your clients that you have to account as free cash flow. So the free cash flow is fake. The free cash flow is wrong. So it's a mistake to look at the price to free cash flow for MercadoLibre. All the people saying, look at the price to free cash flow, maybe they have not seen this line. But lucky me, I have a master's degree in accounting. So I understand this. And you have a clear difference between... How can I check? The forward PE ratio, maybe? That can be better. Forward PE ratio, forward price to free cash flow. Look at the 2 lines and look at the trends since 2021. Here we go. In blue, you have the forward PE ratio for MercadoLibre. Now at 40, which is expensive, right? And in orange, you have the forward price to free cash flow of MercadoLibre, which is at 12. I've seen some people on the internet say that MercadoLibre is extremely cheap because you can have a business growing 30% per year at a price to free cash flow of 12. So it is absolutely crazy valuation. Well, you have to take into account the fintech segment and their cash flow boost because of deposits and the way they manage money. So I would not say price to free cash flow is the best way to value MercadoLibre. You can look at other metrics, EV to EBIT, but I would say just look at the PE ratio and you're fine. You're good to go. So this is a premium business growing 30% per year. So maybe a premium valuation is warranted. We are on the higher end of the valuation framework we have on this YouTube channel. Forward PE ratio of 40. But for some businesses, I think that's warranted. I don't like to go above 30, 35, 40. That's the high end of the valuation framework. But now the stock has dropped. Now the sentiment is shifting. Now the stock is in a drawdown of 23%. So sentiment is bad and the growth just continue. The growth is here. The growth can reaccelerate easily. And this is not the first time we have drawdowns in the stock. If you look at the stock price for MercadoLibre, we are not in a special situation. Actually, you can check Fiscal AI. By the way, you can use Fiscal AI and you can register to Fiscal AI with my link in the description. It will get 15% cheaper if you use my link. And if you look at the past 10 years, this is what you have. Over the past 10 years, you had instances. You have many instances where the stock dropped 20% and rebounded. 20% rebounded. 25% rebounded. 20% rebounded. It's not the first time ever. So nothing really bad. No red flag. The only thing to monitor is the valuation. So either you can buy right now with a PE ratio of 40, or you can greed a little bit and wait. As you want, guys, as you want. But I think as the stock is dropping, that's a pretty good risk-reward opportunity. Okay, that's pretty decent, and I think the potential for MercadoLibre is just immense. The company can continue to grow 30% per year. The company can grow into multiple markets at the same time. It will improve the margins over the very long term. Now they are sacrificing short-term results to benefit long-term results, which is a very smart way to allocate capital. Okay. And the third stock I want to mention today, the third company I want to mention is Meta Platforms. Meta Platforms, you all know this company. Mark Zuckerberg, Facebook, Instagram, WhatsApp, VR headsets, the metaverse, and I've been a shareholder of Meta Platforms since 2018. So I've been following the company for many years. I've seen how competent Mark Zuckerberg is. I've seen how agile this business is. I've seen how efficient and profitable they can be if they want to. And now they are ramping up capex. And the stock did not appreciate this. The stock is in a drawdown of 16% below highs. And after the recent earnings, the stock dropped 10%. And it has not recovered yet. The stock dropped because people are worried they will have too much costs in the future because of AI. People saying this don't have a good track record memory of Mark Zuckerberg. Meta Platforms has many levers to pull to bring margins back up. They can be extremely profitable if they want to. And after the stock dropped, guess what? This is exactly what Mark Zuckerberg did, because they just announced less costs for their metaverse segment, for the virtual reality labs segment. So pretty good efficiency. As always, people always underestimate Mark Zuckerberg, and Mark Zuckerberg always over-deliver. And this is great news for long-term shareholders, because long-term shareholders can benefit. And now Meta Platforms is enjoying gross margins of 80%, net margins of 30%. You have an oligopoly in the online digital marketing. Revenue is growing immensely. Revenue is reaccelerating thanks to AI. Right now, the latest data we have is revenue growth of 26%. So immense revenue growth. The company is taking more debt to do more data centers and more capex. So more capex, more growth, and you can get everything with the PE ratio, forward PE ratio of 22. So the valuation is quite reasonable, forward PE ratio of 22, for one of the Magnificent 7 companies that is a leader in its category, with the top 5 CEOs of the world, and revenue growth rate of 26%. So out of all the Magnificent 7 companies, out of all the companies in the S&P 500, Meta Platforms is a premium business that is growing at a premium number, but it is trading at a reasonable valuation. It's not trading at a premium valuation. So you have a gap. You have a gap between the quality of the stock and the price of the stock. So I think Meta Platforms, it's a pretty good buy right now. I'm a shareholder. It's maybe 9 or 10% of my portfolio right now, full disclosure. So I'm biased, obviously. And I think, if I didn't have such a big allocation in my portfolio, I would have bought the dip here. Okay, and I made a video about this a few weeks ago. So yeah, pretty interesting. It's a good long-term hold. Don't doubt the CEO of Mark Zuckerberg. You will be burned if you doubt this CEO. They are focused on efficiency. They are focused on growth. And so far, they are winning. So this is a winning company. And as always, winners keep on winning. So these were 3 companies to buy for 2026. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.